Thank you very much, and welcome everybody. It's great to be here. You know, the last time, or the first time I should say, I met Jeff was in the back of a black cab doing a loop of Canary Wharf where the Reuters offices are. It sounds a little bit weird. The first time I met this guy, we were in the back of a black cab, but we were doing a show about entrepreneurs. It was called Reuters on the Road, and our producers basically found the most thought-provoking, the most interesting, the most savvy entrepreneurs they could, stuck them in the back of a black cab with me, a bunch of GoPro cameras, and said, right, you've got a loop of the wharf, which is about 5-6 minutes, to interview your prey, and Jeff was one of those individuals, and it was a very memorable occasion. There are just a couple of things before we start. There is a link between Cass and Cedars. One of the Cass Investment Fund's portfolio companies raised money on Cedars. We'll talk a little bit about that during this conversation. If you've got a business idea bubbling, we want you to go away feeling inspired on the back of this conversation. Of course, if you're here to find out how to play a part in investing in an interesting business that you or your friends or colleagues or whoever have set up, then this is the event for you as well. Jeff was announced as one of Business Insider's top 50 coolest people in UK tech. I thought it was the top 10, actually.
I think it may have been, actually. But
there you go.
Who's counting?
Yeah. Okay, so top 10 coolest people in UK tech. GQ called you, Jeff, one of the most influential people in Britain. That's a big one. And you believe the UK is the most exciting place in the world to build a startup. That's also something I'd like to talk about. You spend, Jeff, all of your time hearing pitches from hopeful businesses. Pitch Cedars to this lot in 30 seconds.
Wow. So Cedars is an online platform for investing in businesses you believe in and sharing in their success. So what we do is we let investors of all sizes and shapes, from £10 up, back businesses that they find interesting, ranging from super high growth tech plays all the way to local restaurants and theater productions. And we let growth, ambitious, focused businesses raise capital and build community in the process. So not only raise the capital they need to get off the ground, but also build a network of hundreds of people with a vested interest in their success who are there to help them as they grow. And that, in a very short nutshell, is Cedars.
How's it going? How many deals have you done to date? How much money were you looking at?
Yeah, so we've grown very quickly. We launched in July 2012, so we've been live for a little over 3 years. We're approaching 300 deals done, and that really has ranged the gamut from 20 and 30,000 pound very early stage seed companies, all the way up to multi-million pound publicly quoted businesses. We do anywhere from about 3 to 5 million pounds of investment a month at this point, and those sorts of numbers have grown historically kind of 10 to 15% month on month. So we have had a huge growth rate. We've done very well so far, but it's still very, very early days. I mean, we are still a very early company.
I'm trying to do the math as you go along, but when you sat in the back of the cab with me, which was, I think it was in February of last year, you said you need 25 to 30 million pounds of investment per year to be profitable. I'm going to get all these big questions out of the way about your company to start with. Well, have you hit that yet?
Well, so here's the interesting thing. We're way in excess of that in terms of levels of capital, but this space has grown and taken off far faster than we ever anticipated it would, which has meant that we are now spending far more on marketing and other forms of growth than we thought we would. And it's a blessing and a curse, to be very honest. I mean, when we started out, we kind of thought we were building a bit of a niche business that was, focused on a very particular type of business, that we were going to find a particular type of investor, and we had this little world to ourselves, and the kind of marketing investment and growth investment wouldn't be all that significant. Good news is the opportunity has turned out to be much greater than we anticipated across geographies, across stages of business, across sectors of business. Bad news, or if you call it that, is that it's a lot more expensive to build that, and has taken a lot more investment. I don't have for you a definitively updated figure on what our break-even point is, but it is not 25 million pounds a year.
And you raised money yourself, actually.
We have, yeah. So this summer we raised our Series A, so we'd raised a bunch of money both through crowdfunding. We've raised twice through our own platform. We also have had a bunch of seed and angel money. But this summer we took our first major institutional capital from Neil Woodford, the city fund manager, and from Augmentum Capital, which is a Lord Rothschild backed fund. That was very exciting. It was about a £10 million round. It was something we had been working toward for a long time, building the levels of traction needed to get to that sort of milestone, and we're now using that capital to really invest significantly in growth.
What makes you different from the Zopas, the funding circles, the other peer-to-peer lenders?
Yeah, well, so I mean, maybe just worth very quickly saying for those who don't know the space, and I have no reason many of you would, is that there's this kind of broad term called crowdfunding, and it means a whole heck of a lot of different things that are sort of only very vaguely related. But broadly, you have three kinds of crowdfunding. You have what's known as rewards-based crowdfunding, which is Kickstarter, Indiegogo, other platforms like that, where there's no investment, but what you're doing is you're funding a project you believe in, you're funding something just for the fun of it, or often to get some sort of non-monetary reward. Somebody wants to make a cool new product of some sort, you fund them and you get a part of the product. That's one thing. Peer-to-peer lending or debt crowdfunding is the second. Zopa, Funding Circle, RateSetter are fantastic businesses. That whole sector is sort of 4 years ahead of equity where we sit and so have gotten quite big at this stage. And what they're doing is lending either to individuals or businesses. So these, in the case of businesses, are steady state, relatively safe companies. You're lending money to them, which gets paid back at a 5%, 6% interest rate, steady year in, year out. Those are often, I joke with those guys, it's often the kind of the boring manufacturing business in the Midlands. But it's a fantastic form of investing. What we do, the newest form, is equity crowdfunding, and that is about buying shares, investing in the equity of businesses that are very high risk, that are very likely to fail, but if they succeed, can succeed in a really tremendous way. And what we're giving people the opportunity to do is back maybe the next Google, Facebook, whatever, or even the next business, and there are a whole lot more of these than Googles and Facebooks that raise money at a 500,000 or £1 million pound valuation and sell for 50 or 100 million down the road, and that's where we sit in the market.
All right, let's do this then in two parts. First from the investor's perspective, and then we'll look at the businesses, the sort of businesses that you think will do best. So I'm an investor. I got £100, and I think the minimum is £10. Is that right? Okay. So I've got £100. I want to put it in a business. I give you the money. How and when do I get my money back?
Well, so first of all, you don't really give us the money. You pick the businesses you want to invest in. That's an important point. We have a whole range of campaigns on the platform at any given time, and you're choosing, okay, I want to put £100 into that business. Once you've chosen to invest in that business and it hits its target and the deal closes and all that stuff, you are an equity holder and very much in the same position as any other private investor, an angel or venture capital firm is, which means you're waiting for some form of an exit event usually, either the company floating on a stock exchange or selling or having a management buyout. In some limited cases, depending on the type of business, you see dividend payments. That tends to be the minority in the startup world. The significant majority is you're there for 5 years, 7 years, 10 years, however long it may take for that business to succeed if it succeeds.
Have there been any exits for crowdfunding for you guys yet?
There have been no exits yet. We wouldn't expect to start seeing significant exits. Well, we've got a couple minor ones sort of in the works, but we wouldn't expect to see significant exits probably for another 3 to 4 years.
I think I've thrown this quote at you in the past, but I'm going to do it again now for the benefit of these guys. Sir James Dyson. Crowdfunding has been useless for bringing revolutionary engineering inventions to the market because the public are too focused on fashionable startups and quick returns on capital.
Well, I think that crowdfunding clearly demonstrates that the public is not particularly focused on quick returns on capital. I mean, this is a very, very long-term asset class, and the immense popularity of it that we've seen. We've had well over 15,000 people make one or more investments. We have 1,500 to 2,500 people making investment every single month. And these are people who, they get it. They get that this is long-term. In terms of whether they are backing real sort of engineering miracles versus more commercially focused businesses, look, it's a reasonable point. I don't necessarily think that crowdfunding is going to be right for every type of business. It certainly is not right for pure enterprise software plays. If you have an awesome way of taking Oracle and implementing it into some big business's back office, he's not going to fund through crowdfunding. It's not the sort of thing that appeals to or attracts wide number of investors. Crowdfunding tends to work certainly for consumer-facing businesses, be they consumer products, be they digital, be they retail, as well as a range of B2B-focused plays where it's a problem and a solution that many people can understand. So, look, I think, Sir James has been sort of bearish on the internet generally, and it hasn't served him very well. But in fairness, I think he's right. Crowdfunding does not necessarily fund, the next cool little sort of industrial engineering project. But it's got a whole lot of other stuff.
But why do you think, though, Jeff, people put a £10, £20 investment into an interesting company? It's not really to make money from that company, is it?
It is. It absolutely is.
Isn't it just to feel part of the process and that ecosystem?
You see, the thing is, it's both. And the two aren't mutually exclusive. So what we find in all the research we have from our customers is that the financial return is the threshold. People are not investing in deals unless they believe that there's a financial return to be had. And there's a very narrow exception for family investments. So every so often you'll get family members putting in investments just to support their family member. But 98% of our investors are only there for the financial return. And one thing, you didn't quite phrase it this way, but I will still argue against it, is that there's a conception that if you're investing £10, you must not care as much about returns as if you were investing £100,000. I think that's a load of you-know-what. I mean, I think I come from a family and a place where I was given about $10 worth of shares when I was a child in a particular company to hold and see grow. And the reality is that whether you're talking about a little bit of money or a lot of money, the proportionate returns are the exact same. $10 in or £10 into £100 is the same as £100,000 into $1 million, and everybody has different levels of assets that they want to invest. So the financial bit is absolutely key to everybody. But on top of that, why are they choosing this asset class over others? Why are they choosing certain deals instead of others? It's because often, in addition to the financial return, there is an affinity for the business. There is an interest in what they're doing. Yeah. And really interestingly, those two go together very well. When you understand what a business does and you believe in the team and you believe in the product, you're more likely to make money off of it if you think it's a good investment. And I think the reason many people come to us is they're a little bit sick of their IFAs or other wealth managers putting them into weird synthetic products that they don't understand and blow up in their faces. They want to back a guy who they understand, they get the product, they and their friends want to buy the product because it's fun to be part of, but more importantly because they can make a heck of a lot of money off of it.
And you have a risk test, don't you, for investors?
We do.
Because I mean, you've been quite vocal about this in the past, that it's quite demeaning talking of the small investor as not understanding the risks as well as the big investor. What do you think on that?
Absolutely. So there traditionally, historically, financial regulation has had this sort of ridiculous dichotomy in it that has essentially said, if you are rich, if you are over a certain level in terms of income or assets, you're a big boy or a big girl and you can go off and invest in whatever you want. And if you are anybody else, not at that level financially, you are a complete blithering idiot that needs the hand of the state holding yours at all times. And we have really come in and rejected that fairly strongly. And I think that what we have recognized is that there is a vast range of people. We talk about them as the mass affluent sometimes, lots of terms, but who are just generally sensible, grown-up adults who understand risk, who understand what they're doing. They may not be investing in or creating complex derivative instruments, but frankly, that's probably just as good.
It's in your interest to reject it, though, of course, because you wouldn't have a business if you didn't, right?
Well, it's in our interest what?
To reject that idea of these people not understanding risk.
Well, we wouldn't have formed the business if we didn't believe in that. When we first started working on this, we said, look at this huge, this was back in 2009, we said, look at this huge portion of the population. Look at what they demand, look at what they want, look at what they're able to do. They're being underserved, and we built this to serve them.
It brings us nicely on to regulation, because of course, I know the SEC recently has made things easier with the Jobs Act in the US, but let's face it, there wasn't that trust in the small investor in the US to get these things right, was there?
No, I think, this is a really, really interesting case of how British and American regulation have diverged. And just as a little bit of historical context here, Britain, along with most of Europe, adopted its current regulatory system. Britain was 2000, most of Europe sort of in the 1990s or early 2000s. America goes back to the 1930s. It's been the same regulatory system since then. And as a result, many of the problems that the American system is really focused on and trying to address are 1930s era problems. And you will still hear people at the SEC and elsewhere talk about this fear of a guy showing up in some town and going door to door selling investments with pieces of paper that turn out to be worth nothing and fleeing. I think that the British system in particular has been much better adapted to the realities of the digital age, which involve far better communications, far more transparency, far better information than the man on the street had in the 1930s. And so we were the first regulated platform in the world. And the way we achieved that was we built our model, we looked at how to do this. We then went to what was then the Financial Services Authority in 2011 and said, hey, here's what we're going to do. And not only do we think this works under your existing rules, but also this works under your policy considerations. The things you are worried about, the things that you care about, this fits with all of them. And it was a whole long sort of analysis that went all the way to the very top of the FSA. And the ultimate answer was, yep, you're right. We do think this makes sense. We do think this is something investors should have. And we got authorized. It has taken the U.S. significantly longer to get to that point. And it's still quite far from being where it needs to be.
Why do you think it's taken the financial industry so long to innovate online? Because let's face it, it has taken a long time.
Because it's largely, so much of the financial industry is run or at least guarded by stuffy old lawyers like I used to be. I began my career as a corporate lawyer, and my job was to say no to anything innovative, and that's part of why I left. If you believe that your risk tolerance has to be zero, you will never innovate. Innovation is about taking risk. It's about taking a chance for failure, and I think that for a very long time, financial institutions and those advising them have been very, very concerned about it. And it has taken, I'm one of a wide number of people, many far more successful than I, who broke off and said, you know what, it just doesn't need to be this way. We can apply the same standards of professionalism, but push the boundaries a bit, try things new. If it doesn't work, we'll pivot, we'll change a little bit. And that's part of why we're now finally seeing this fintech revolution that's happening in the UK.
Was the crisis, 08, 09, and let's face it, we're still bubbling along at the moment. Was that good for your business or bad for your business? For the model, for the idea, for the concept?
I think it was good for the model, and I think it was good for the broader area of financial innovation. I mean, I think to our business in particular, one of the things that investors started to realize and regulators started to realize was, you used to think that you'd invest in publicly quoted stocks and shares, publicly listed stocks and shares on the basis that they're never going to go up that much. Maybe if you're lucky, you'll see 5%, 7% appreciation, but at least your downside is protected. At least you can't lose it all. And then a whole bunch of people lost it all. And a whole bunch of people started saying, you know what? If there's this much risk in the system and there's this much of a prospect of businesses failing, which they do, which is a reality of commerce and reality of the modern world, guess what? I want the upside too. And so a lot of people, I think, have shifted portions of their assets, portions of their investment portfolio into these higher risk asset classes because at least they're getting the upside to compensate for the risk in a way that pre-financial crisis they weren't.
All right, let's get to the business side now. What sorts of companies, in your view, tend to do best? What is succeeding for Cedars?
Yeah, well, so it's really interesting. A wide range of sectors tends to do well on the platform. When we started, we kind of thought in terms of primarily tech. We really were thinking in terms of the kind of shortage techie types, and we still have a lot of those, and a lot of those have been very successful, and a lot of those have both funded and gone on to great things. But we're seeing increasing numbers of consumer products businesses, retail businesses, e-commerce, even things a little bit wilder like entertainment assets. We've done a few theater productions and a number of films. And success actually has a lot less to do with the particular sector than it does with the quality of the campaign and the quality of the business presented. So, first of all, the valuations need to be reasonable. One of the things, for those of you who do follow the crowdfunding world one of the things that's been talked about a lot in the last 6 months to a year is that valuations on the platforms, or on all platforms, including Cedars, appear to be going up a lot. And valuations are take it or leave it. Business says, how much equity is it raising? How much capital is it raising? How much equity is it willing to give away? And a lot of people, as the market has gotten more robust, have started to say, I'm going to try for something really, really high. But what's really interesting is those deals aren't funding. The deals that are funding are the ones that are being realistically priced. And there's been this assumption that, it's the crowd, they're not going to understand valuation. Nonsense. They seem to understand it better than most angel investors do. They really, really, really care about the pricing of a deal. A great company at a £500,000 pre-money valuation may not be a great company at a £5 million valuation. So valuation is a very important thing. Quality of pitch, quality of expression, very important to convince people that you know what you're doing, that you believe in it. And then most importantly, I think, or certainly equally importantly, is actually going out there and campaigning. Crowdfunding in all of its guises, be it Kickstarter, be it Seedrs, never works when you just see it as a listing, when you just see it as, hey, I'm going to put up my business and people are going to throw money at it.
Right.
Crowdfunding is always about going to your friends and family, getting publicity, hustle, hustle, hustle. Those are the deals that do well.
Just very quickly talk us through, if someone in this room had a great idea,
Yep.
they were really developing this idea, take us through the process now. What would they do if they wanted to work with Seedrs?
So what happens is you come to the platform and you create a campaign directly through the platform. It's a very simple online form, all very straightforward. We're always happy if you want to reach out first and grab coffee or have a chat on the phone about the process. Always happy to do it, but we've tried, and if we do our job well, you sort of shouldn't need it. We should have enough information and guidance there for you. But in any event, you create the campaign, we review it. Part of our review, and this is what often surprises entrepreneurs, is a fairly detailed verification process and diligence process. We're not trying to decide, do we think you're a good business? We're not trying to decide, do we think that this is going to succeed? But we are trying to make sure that by the time you go live on the platform, we have confirmed that you are what you say on the tin. And so you say you're currently an MBA student at Cass, we want to see some form of evidence of that. You want to say that the market size that you're tackling is X number, we want to see some sort of evidence of that. So we go through that due diligence process. Once we're happy with the campaign, once you're happy with the campaign, it goes live, and it has 60 days to hit its target. And that winds up being a mix of yours, the entrepreneur's efforts to go publicize and bring in investors, along with the attention that all of our existing investors give to it by seeing it on the platform.
Why go to a crowdfunding site like Seedr, a platform like Seedrs, rather than go to an angel investor, rather than go to a VC? Does your idea have to be better thought through if you go to a VC?
No, it doesn't have to be better thought through to go to a VC or angel. Actually, in some cases, it probably gets a little bit less scrutiny. By and large, venture capital is for somewhat later stage deals. There are seed funds out there that do invest on the basis of ideas or do invest at a very early stage. But that we find that the overlap between the deals that we do and the deals that VCs do in terms of stage, it tends to be you come to crowdfunding first and then you do VC after. Angel is a very different story. Look, I'm very bullish on venture capital. I think there's some fantastic venture capital firms out there. We've taken money from them. I think there's some not great ones, like in any industry, but I think that it's great space. I'm less bullish on the sort of traditional old-fashioned angel community, which I think has been characterized by a very, very sort of antiquated way of thinking about how to look at businesses, about what counts as a growth business. They often take up massive amounts of time, and then once they invest, claim to add a huge amount of value and don't necessarily do so. There are great angels, you can find them, but I actually tend to see that as an inferior option to crowdfunding or to VC in a way that, and I think more and more people are seeing it. The one extra thing I would say, though, is that even for businesses that are at venture capital stage, what we see many people doing, including Humble Grape, which raised money from both the Cass Entrepreneurship Fund and from us, is you're getting the best of both worlds. Having a great institutional investor behind you who can add value in the way they do, and then having crowds of your potential customers and supporters behind you, and having them together is just a fantastic outcome.
That's the ideal world, but is it also the fact that you need to go to a VC, or that you might go to a VC, or in fact Seedrs did the same thing, an admission that you can only do so much with crowdfunding?
Well, it's interesting. I mean, there's one very, very, very a clear and definitive limitation, which is you can only do €5 million, or about £3.5 million pounds a year under regulation.
And that's $1 million in the US, isn't it?
And it's $1 million in the US,
right.
Exactly. So one thing is, for now, unless the regulations change or unless we figure out something clever, there's a certain upper scale limit. And whether, could this someday become a form of finance that does £50 million C rounds? Maybe, but that's not what it looks like today. So there is that. There's also the fact, and I think this is very important, that, again, good venture capital firms can add, and good institutional investors can add a lot to a business at a particular stage of growth. When you get up to a certain level in terms of size, when you're starting to face the same kind of commercial problems that many other businesses have faced, the advantages of having those sorts of people on your board are very significant. And I can tell you this from personal experience. I mean, I will be very frank, I won't name names, but I'll be very frank in saying that very soon after we launched, when we were still a real sort of seed company, we had a hugely experienced individual who'd made massive success in the business world come onto our board. We invited him on. And his advice was terrible. And it was terrible not because he was a bad guy or because he was stupid. It was just that the problems that he had faced at his stage of business and what he was accustomed to dealing with were so different from the really novel and just brand new problems that a business like ours that was carving out a new path faced, that it just didn't work. Now, fast forward a few years, we've just had we've just had a couple of the venture capitalists who invested in us come onto our board. And it's been amazing because we're now starting to face a lot of the same issues that businesses they invested in faced a few years ago. They're kind of sharing with us in generic terms how those businesses tackled them, thinking about how we can tackle them. And it's been hugely valuable, but it took our getting to that stage before that was very useful. So I do think there is great value in institutional capital sitting alongside crowdfunding once a business gets to a certain stage.
Why London versus Berlin versus Tel Aviv versus the Valley?
So London's the center of the world. No, look,
but in terms of, because let's face it,
Yeah.
I have talked many times with people in the back of the cab that there is not enough funding available in Europe.
Yep.
If we compare it to the US.
Yeah.
I mean, that must be a problem.
So, look, I think that the funding situation here is a heck of a lot better than it's been, and it continues to get better. We see more and more VC funds, we see platforms like ours and many others popping up here. We see more and more capital coming from the US into Europe. So it is, the trend line is fantastic, but there's still a ways to go. Look, I think the Valley's great, Tel Aviv is great, Berlin's great. There are a lot of great places to start a business. But I think what's so exciting about London is the huge level of international connectivity. I mean, if you want to build a pure tech business for the US, in the US, and never care to look outside your borders, fine, Silicon Valley will do great. But one of the things about the Valley that I find, and it frustrates me every time I'm there, is, if it doesn't happen within a 50-mile sort of stretch of the 101, it doesn't matter. I mean, there's just no recognition that there's anything else in the world. One of the things I've always loved about London, and I say this as an expat/immigrant who moved here 10 years ago, is that it has an immense level of connectivity. I mean, some of it's historical as a result of the Empire and Commonwealth. Some of it's just by the fact that we're sort of a smallish island in the North Sea, and we've had to look elsewhere for trade and all. But the level of connectivity to Asia, to Africa, over to America, throughout Europe, is just fantastic. And if you want to build a truly global business, I think we have that much more than the Valley. I think we have it more than Israel, although there's some great technical talent there. We have it more than Berlin, although Berlin's an exciting city too.
The obvious follow-up question has to be, fair enough, Jeff, but we don't have the Facebook, we don't have the Google, we don't have that huge success story that the US has. Doesn't that say a lot?
Well, it's interesting. I mean, for one thing, there have been a huge number of businesses that have grown to significant size here and then gotten purchased by American companies. And I don't particularly see that as a failure. I mean, I don't know. Success is not simply building a business organically to its biggest size. If you had a number of people here who built a business, it got bought by Google, they became Google shareholders, and then participated in the broader growth, I'm a little less precious about that. I think if you're a government or a promotional agency for London, it doesn't give you as many good success stories. But if you're just looking at the numbers, I think it fairly well equates. However, I also think that things are changing dramatically. I mean, I think that the London that I walked into when we started working on Cedars in 2009 was unrecognizable from a startup perspective. I mean, you would go to these conferences. I know some of you may have heard of the Dublin Web Summit issues with it. Anyway, it's 40,000 people or something converging on Dublin. We have conferences here that are 5,000, 10,000. I mean, we used to go to conferences organized by the same people that were like the size of this room, and this was considered a really, really big and exciting tech conference for London, and it has just changed so dramatically. The recognition has been. So we were 10 years, 15 years behind here. I think we're seeing businesses like TransferWise, like Funding Circle. We see these unicorn businesses with billion-dollar-plus valuations growing here. I think it's a few more years before we see them reach mega scale, but I think, again, the trend line is pointing in the right direction.
I know you've got to be careful naming companies that you work with. Can you give us a little taster of some of the companies who work with you that we should keep an eye on now?
Yeah, and I'll give you two, and they're two at very different ends of the sort of early stage business spectrum, but I think very much representative of what we do. So one's a business called LandBay. It's a fintech business. It is a peer-to-peer lending business, actually, so in an adjacent space to ours, but focused on buy-to-let mortgages. It has been an absolute rocket star. I mean, this is your sort of classic tech story. Tiny little thing, a couple of guys came up with this idea, raised a little bit of money, then raised some more, raised some venture, have done a whole bunch of partnerships, got massive credit facilities going through. And that is, and they've come back and done a few more rounds through us, really smart team. That is a classic sort of super high growth tech company. Other end of the spectrum is a company called Oppo Ice Cream, which is a business started by two brothers. And the whole point of it is to make a type of ice cream that is significantly healthier by using a stevia leaf instead of sugar and coconut milk instead of cream. And it tastes absolutely delicious. And as somebody who loves ice cream and shouldn't be eating so much of it, it is something that is very near and dear to my heart. But more than that, these are just the best business people. By the time they came to us, they'd already sort of hustled their way into an initial Waitrose distribution deal, and they're now getting more and more of that. But my favorite story about them is that somehow or another they wangled their way onto the Prime Minister's airplane as part of a trade delegation to Milan to showcase their product. And if you can get yourself to a position where you are selling ice cream to the Italians, you have done something really quite remarkable. And so that, and in very serious terms, is this a multi-billion-dollar business, pound business? Could be, unlikely. Is it a business that, if it can get some, expand its distribution, expand its product line, becomes an interesting acquisition target for Unilever or Nestle or somebody like that in a few years' time? Very much so. So, it's a wide range of businesses we deal with. Those are two good examples, but we have many.
And just very quickly before I throw it out of the audience, you take your cut with a 7.5% at the outset, and then a 7.5% when the business is sold or IPOs or whatever.
Exactly. So we take two fees. We take a commission on funds raised up to 7.5%. For if you bring your own investors to the deal, we charge a little less. But it's a commission on funds raised, which means that we're charging the company when they have succeeded at doing what they came to us for, which is raising capital. And then we're charging the investor a carry, which says that if you don't make money off your investment, we don't make money from you. But if you achieve profits through sale, through dividends, through whatever, we take 7.5% of the upside. And so we have an aligned interest with the investors all the way through exit.
Well, Jeff, we thank you for your candor. We thank you for your insight. And we thank you for your wit. Jeff Lynn, everybody.
Thank you all very much. Thank you.